Welcome back to Finance News, the only place on the internet giving you all the goings on across the stock market, business and investing from the US, around the world and close to home here in the UK. As always, it's been a crazy couple of weeks in the markets as we welcome millions more bag holders and commodity experts to the community. Let's get straight into the headlines. First up, fresh inflation data from the US shows the cost of living rising faster than ever, showing no signs of slowing up. Data from the CPI, the Consumer Price Index, which measures the changes in prices of goods each month, has shown a 7.9% increase in overall cost to US households from just 12 months before. The jump in prices is at its fastest rate since 1982 and even rose 0.8% when compared just to the previous month. The largest contributors were yet again the rising cost of energy, which affects virtually all of the other goods in the basket that's measured. However, when taking out food and energy, costs and the core of the CPI data still shows a 6.4% rise in prices when compared to costs just 12 months before. To combat these effects, the Federal Reserve is expected to lift interest rates next week for the first time since 2018, with Wall Street pricing in multiple increases throughout the next year and beyond, as Jerome Powell attempts to keep inflation away from becoming more than just transitory. Sorry guys, the money printer needs to go in reverse for a while. Global oil prices fell on Wednesday by the most in nearly 2 years after OPEC agreed to support more oil into the marketplace after the supply chain disruptions caused by the Russia-Ukraine conflict. Brent crude futures ended down $16, which was more than 13% off their previous highs, as the black gold commodity had seen its prices rise due to constraints around its supply. Consumers and businesses around the world are facing increased pressures on bottom lines and monthly household budgets, as the price to fill up cars at fuel stations and to move goods between suppliers has increased significantly over the past couple of years. Looks like we're going to have to either go back to horses and carts or drive Teslas. Welcome to the future. Sticking with commodities, gold has seen a resurgence in trading volume and price after hitting over $2,000 an ounce. The price rise has tempted many new traders to put their money into the precious metal, who has seen its price trade the highest since the summer of 2020. Investment bank Goldman Sachs is forecasting the demand to remain strong over the next 3 to 6 months, with the bank predicting a price change up to $2,500 if things remain as they are. They cite the increase in demand will come from all areas: consumers, investors, central banks and institutional buyers looking at protecting their cash from being eaten away by inflation. Gold bulls can now finally bask in their glory, which they've been predicting for years. You see, if you keep saying the price will go up, eventually you'll be right. Genius. McDonald's, the world's largest fast food chain, has joined other prominent brands and companies who are shutting shop in Russia temporarily as the invasion of Ukraine has shocked the world. The franchise restaurant fast food chain, which operates restaurants in Russia directly, has shut up shop and vows to ensure that all staff remain paid during the time that it's closed. It estimates that the closure will cost the company $50 million per month as it joins other prominent brands like IKEA, Starbucks, Coca-Cola and Apple. In response to the closure, the Russian administration has said they're considering the proposal to nationalize assets of foreign companies who have pulled out of the country by suggesting that they could be forcibly taken by the state. US officials have hit back at this by saying that it would set Russia back decades and significantly reduce foreign investment. Post your thoughts in the comments below on what the new Russian nationalised Big Mac meal would be called. Staying with other household names and massive US giants, Amazon has announced a 20-to-1 stock split and major share buyback program. The online retail giant and cloud service provider announced this week that it intends to split its shares to ensure that both staff and retail investors have a better opportunity to buy stock in the company. The split will be the first since the dot-com boom of 1999, but the fourth in the company history since the IPO in 1997. With shares trading currently around $2,900, the announcement got investors excited, who promptly invested into the company, which saw a 5% rise in its share price so far this week, against a sea of red across the rest of the markets. The company also is set to authorize a $10 billion share buyback program. Now, just a reminder to shareholders that a stock split changes nothing fundamentally about a company, but it is good marketing and more people will assume cheap means good. In news closer to home, the UK government has taken a tough stance with Russian oligarchs and began to freeze assets with anyone linked with alleged ties to the Kremlin. Joining the rest of the world and the rest of the European Union, Chelsea Football Club owner Roman Abramovich has been sanctioned by the government with all assets frozen, including a major shareholding in UK-listed mining company Evraz. In response to the action, Chelsea Football Club will still be able to continue their business, but the sale of the club, which was announced by the owner, will not be able to go through until the sanctions have been lifted. The news caused the London Stock Exchange to halt trading in the global steel giant Evraz, as it also announced its recent dividend payment would be stopped too, whilst it will be unable to get money to shareholders. The entire 10-strong non-exec board of the company has also resigned, with their concerns around the links to the oligarch who owns 29% stake in the company, which has shrunk in value as the share price is now frozen under 85p from highs above 600p earlier last year. I can confirm I am a current bag holder. Other firms have been caught up in the conflict, with shares either being frozen or also losing significant value. Companies like Polymetal and other major Russian banks have seen their price tumble in recent weeks. With all this going on the London markets, however, it looks like the FTSE 100 is going to see its biggest weekly gain in over a year, according to reporting in the Times, with companies like British Airways parent IAG and even popular movie chain Cineworld up on the end of week trading. Just another week of winners and losers. Speaking of losers though, as the price of living here in the UK soars, the Chancellor of the Exchequer, Rishi Sunak, is under pressure from his own party to ensure that consumers do not face a massive household budget squeeze in the new tax year. Sunak will take some limited action to tackle the cost of living crisis in this month's spring statement, but will reject calls to beef up his much criticised energy bill reduction tax scheme. Taxpayers are set to see a one-off rebate to council tax bills this year and a long-term grant on energy bills as wholesale prices have risen significantly. In our final news story, SpaceX CEO Elon Musk came through on a pledge to deliver Starlink in late February after Ukraine's lack of connectivity had an official ask Musk personally for assistance on Twitter. Starlink is Musk's satellite-based internet service that allows users to connect to the World Wide Web using a small dish connected up to their computer, sending a direct connection to orbiting satellites around the globe. The request for support came in due to multiple Russian restrictions and damage to connectivity caused by the invasion, which the Starlink system will be able to circumvent. Pretty damn cool. Now time to look at this week's fails of the week, because not everything can be as interesting as satellite-based broadband. Just when you think it couldn't get any worse, fails of the week. As many things as there were to choose from this week, the winner for me was a story about Russia holding commercial planes hostage. The Kremlin threatened to impound nearly 800 commercial airlines, which had been leased to Russian airlines, worth a total of $10 billion. A draft law has been proposed by the Russian Transport Ministry that states payments should be made in rubles for the whole of 2022, which would, by default, allow them not to be returned if payments are not accepted. The proposal also states that a government commission would decide whether to return the planes or not. Something tells me this might be a bit one-sided. And now it's time for the fun section, where we address some of the best memes from Reddit's Wall Street Bets. Welcome to the best of the bets. As inflation in the US takes hold, this video shows us just how quickly prices at the pumps are rising. Quick everyone, this is something we need to invest in. What's the ticker symbol for this? If you're a degenerate gambler and love making trades every second of the day, then you'll probably recognise this picture. If you think a market crash is a great time to invest in a globally sanctioned country in complete turmoil, all the best of luck to you. Linking nicely to the last picture, in this one we see the effects of buying the dip, which keeps on dipping. The problem is you never know if you're trying to catch a falling knife and where the bottom really is. You could even end up being a bag holder with your shares suspended. And finally, here's a new currency you probably won't want to invest in. You might get a lot of them, but having more zeros in this money will probably not even buy you a loaf of bread. But you can go and try and get it if you want. On that note, thanks for watching. See you the same time next week. Drop me a like if you found the video useful and subscribe for many more. And until then, happy investing.